Andy, what's up? It's Major Tom.
Hi, Roger, Major Tom. This is ApeAndy to Major Tom. I read you loud and clear. And you have been reading Rule 803.
Yep, been doing a ton of work into reading 803, decoding it. There's not many
Awesome.
YouTubers out there that can decode it and kind of like put it in ape speak. So,
Like I said, you're the DD guy. You are the capital V, capital DD, capital guy. Yes.
yes. So I've kind of like annotated and highlighted like throughout the entire document. We're doing 175 pages in this weekly video, and then in the next weekly video or midway through the week, we'll do another video together, finishing out the document completely, and then we'll like summarize it and everything like that. At the end of each one of these videos, we'll kind of just like talk about what everything together means and how this is going to play forward.
Right. See, this document is so big, it takes us two weekly videos to go through it. Go ahead,
Yeah.
Major Tom.
All right. So let me just get this document in here, and let's just present.
Actually, it's even okay if you don't get the document in here because it's so many words. The font is so small, and the viewers just want to have it in a nutshell, or maybe it takes two nutshells.
That's true. All right. So you do make a good point there. I don't think I need to show the document to the viewers. Let's just keep this open, and we'll just keep our faces here for the video. And it looks like we'll start it out. You open 803, right? And basically, I'm just scrolling down. The NSCC is proposing to introduce central clearing for short hedge funds, and they want to do
Central
this.
clearing.
Yes. So basically, like the NSCC is going to become the middleman in this entire thing. So if
Okay.
a short hedge fund, like in a nutshell, is going to go to the NSCC, become a member, and then if someone wants to lend shares, they're also going to go to the NSCC. And let's say BlackRock's going to lend their shares, so they're going to give it to the
Uh,
NSCC, and then they're going to borrow from the NSCC.
how about if we use Andy Hedge Fund and Tom Hedge Fund instead
Yeah,
of
right. Let's not use legal names. So I want to lend Andy hedge fund shares, but I'm not going to go directly to Andy through a dark pool anymore. I'm going to use the NSCC because there's multiple benefits now for me to use the NSCC instead. So,
right?
I'm going to go to the NSCC. I'm going to lend you my shares through them. And,
So NSCC is the middleman.
yes. And this is going to be now on a 1 business day term. Let's see. In particular, the proposed clearing service would expand central clearing at NSCC to include, yes. So it's going to be a 1 business day term in eligible equity securities that are entered into by members. All right. So all of this, if you wanted to lend shares and I wanted to, you know, borrow the shares, that transaction is going to take 1 business day.
Okay.
All
Right.
right.
Now, Andy Hedge Fund would like to borrow GME from Tom Hedge Fund.
Yep.
So
One
we
business
have to
day.
do it through NSCC.
Mm-hmm.
Now, okay, and then I borrowed 100 shares or 1,000 shares of GME or AMC because these are our beloved meme stocks. And then I'm red team. I shorted. I'm shorting. I sell the 100 shares of GME I borrowed. I sell the 1,000 shares of AMC I borrowed. Okay, and then something happened. Then the price went up. The apes keep buying AMC. The apes keep buying GME. And then Andy Hedge Fund got margin called. What happens now?
Right. We're going to get into that. So going down this document, the NSCC believes that broadening the scope of central clearing at the NSCC to short hedge funds would also reduce the potential for market disruption from fire sales. So the NSCC is essentially becoming the middleman because they're trying to protect the stock market as a whole from major sell-offs because your hedge fund is going to basically lose all of its collateral.
Correct.
You're going to
Because
lose
if
all your Apple. You're going to lose all your
okay,
Tesla.
right. Okay, let me put it this way for the ELI5 viewers. If I get margin called, I have to sell all my long positions in Tesla, all my long positions in NVIDIA, in order to provide cash for the collateral of the margin call of AMC and GME. And what happens? Market crashes, right?
Yes, exactly. That's what the
So,
NSCC is trying to prevent.
okay.
All right. So
Go ahead.
first, in the event of a default, NSCC would conduct a centralized orderly liquidation of the defaulter's SFT positions as defined below in the proposed rule change. So the NSCC can sell off your collateral positions slowly to prevent a market fire sale, as they describe it, a market fire sale.
Right. In other words, NSCC Rule 2021-803, our viewers can Google that, NSCC-2021 for the year 2021, this year, hyphen 803, you could Google that. This rule, once it's in effect, it will prevent a market crash despite AMC and GME, despite meme stocks going up. Go ahead,
Yep.
Major Tom.
And this, so limiting the positions that need to be liquidated to the defaulter's net positions should fire sale risk is the risk of, okay, so basically the collateral trades at the NSCC do not have to be entire account driven. So like if you enter a short position, you're only going to put up as collateral enough shares to cover that short position. So if
Right.
you were to default on those shares, you only lose those shares. You don't lose your entire account.
I don't lose my entire warehouse.
Yes, yes, because when you enter a short position at the NSCC, you only have to post collateral to 100% of this value.
Correct. So let me put it this way. If I get margin called on AMC, I put collateral only for AMC. I don't
Yes.
have to put collateral for my GME because
Right,
I
they're going to
only
be
have two
separate.
meme stock in the warehouse.
Right,
They're
they'll
going to
be
be separate.
they'll be separate. So if you want to
Understood.
short AMC, you have to post collateral in shares and cash for AMC. If you want to short GME, you have to do that separately in a separate transaction. Collateral is different.
Understood.
And this also separates the short hedge funds long positions because basically before all of it was entire account driven. So basically, if their long positions dropped in value, they would get margin called on both of these. No longer is
Correct.
this the case because they're separate. Separate collateral, not the same collateral.
Correct. Understood. Understood.
Okay, so NSCC would use its risk management resources to provide confidence to market participants that they will receive back their cash or securities as applicable, which should limit the propensity for market participants to seek to unwind their transactions in a stressed market scenario. So the NSCC might use some resources to help hedge funds recoup their money. That's all that means.
It's not because the NSCC is standing on the side of the SHF, the shorting hedge fund. It's because the NSCC wants to be a good guy protecting the entire market's integrity.
Yes. These runs, quote unquote, may require institutional firm lenders to quickly sell off securities that are the subject of their cash reinvestments to raise cash to return to the borrowers their shares.
Okay, I get margin called on AMC. I provide collateral, but then NSCC middleman, the good guy middleman, still tells the bad guy SHF, you got to take care of your AMC short position. So they cover.
Right. So this is part of the reason why the NSCC
Then
is
AMC
telling
squeezes.
all these people that, hey, you should use us for clearing. This is why. Because people who lend stock are going to want their shares back all at once they realize the mother of all short squeezes is happening. And this could be devastating for the hedge funds. So they should use the NSCC because it's guaranteed that both parties, the lender and the borrower, will get what they own, basically.
So, Major Tom, if this is the case, which it will be the case once it's effective, then the retail and the apes will have their MOAS, but the SHF might still survive.
Right. Because they're only taking the SHF collateral that goes to that short position. They're not liquidating the entire account portfolio.
Right. Because our viewers, Major Tom is doing the DD, I'm doing the ELI5 viewer scenario.
Right. So the NSCC selected $5 as the per share price minimum for underlying equity securities that could be the subject of a novated short hedge fund, because $5 is a common share price minimum adopted in brokerage and margin eligibility schedules. So you can't use the NSCC to borrow any stock that's less than $5 in share price. So if I wanted to short, let's say metamaterials, for example, I can't short
I was just thinking of
metamaterials.
that. I was
Yeah,
just thinking
exactly.
of that. MMAT.
So I
Okay.
can't
Now,
use the NSCC to short metamaterials.
wait. Okay. Now, ApeAndy hedge fund wants to short MMAT. Can I do that through NSCC? No, no, no.
No, it needs
This is
$5
less
share
than
price
five.
minimum. Okay. Um, each SFT would be collateralized by cash equal to no less than 100% of the market value of the lent securities. So what this means, the cash collateral must be equal to the total negative value of the lent securities,
Right.
which is actually not that bad of a deal. Some margin accounts require 120%, 140% of the lent securities. So 100% is actually a good deal, which is another reason why these short hedge funds will be inclined to use the NSCC's services.
Right. Because if they don't use NSCC as a middleman, if they go to others, the collateral would be 140, maybe sometimes even 200.
Right.
Because the other clearinghouse wants to protect themselves. That's why they ask for higher collaterals. So just 1 second, Major Tom. Now, we know that metamaterials was like $7 or $8 or $10 before. At that time, Andy Hedge Fund could short metamaterials using NSCC as a middleman. But once its price gets below 5, no more.
Yep.
So there are two separate scenarios. Andy, short MMAT, while it's $10, and I got what I wanted. Its price is coming down. Once it gets below $5, like $4.98, $4.95, NSCC says, "Oh, you're on your own."
Yep. And this also applies to every other security. Sundial is another popular meme stock. Sundial you can't go through the NSCC for because
It's less than
it's less than
$5.
$5, right? Now the contraction. Here's another statement in here. The contractual remedy that has been developed in the bilateral securities lending markets for these situations as a buy-in. Under this remedy, the lender may purchase securities equivalent to the borrowed securities in the market and charge the borrower for the cost of this purchase. So, in layman's terms, let's say Andy Hedge Fund borrows my shares of GameStop, and I am lending you my shares.
Yes.
And let's say I request my shares back from you, and you fail to deliver.
I defaulted. I failed to deliver. FTD.
Right. No, not anymore. So now, as you know, I can go into the open market now and buy the equal amount of shares that you borrowed from me at market value and then charge you the cost.
I still have to pay for that bill.
Yep.
And I got to pay it in cash.
Yep.
Okay.
Okay.
That prevents bad actors from doing further bad acts.
Yep.
Can I say that?
And
Okay.
it requires the good actors to punish them in the actual exchange where the value actually matters.
And when the good actors buy at market price, what happens to the price? Okay.
All right. So under the proposal, the NSCC is requiring a deposit to the clearing fund for SFT positions, required SFT deposits. So this is just like the SLD window where they were required to store cash at the NSCC. In case that any position got too risky, the clearing funds would be able to use some of that collateral to clear out the short position. So this is the same thing as the SLD requirements, but they're changing it a little. They're changing the terminology of it to basically the required SFT deposit. So it's going from SLD to required SFT deposit. That's all. They're just changing terminology. This is also going to bleed hedge funds out the same way that parking cash at the NSCC would bleed them out earlier. It's the same kind of concept. The NSCC would require that a minimum of 40% of a SFT member's required SFT deposit consist of a combination of cash and eligible clearing fund treasury securities. So 40% of the collateral for your short position must be in cash and treasuries. No
Okay.
exceptions.
Right. Um, Go ahead.
Okay. And the lesser of $5 million dollars or 10% of a SFT member's required SFT deposit, but not less than $250,000 consist of cash. Okay, so 40% of all of your collateral must be cash and treasuries. 10% of that 40% must be in cash.
Okay. What about the other 60%?
That can be Tesla, Apple, anything.
My long positions
Yes.
to put up as collateral for you.
Yes. But under any
Uh,
collateral in any open short position, it must be 40% cash and treasuries as the collateral, or it with and not or and within that 40% cash and treasuries, 10% must be cash minimum.
okay. See, 40%, and inside that 40%, 10% must be cash, and the
Yes.
60% is could be long positions
Right. So
as
for
collateral.
example, Archegos ran into problems because Archegos didn't have any cash. They had all of their long positions parked in like Discovery and something else. And basically, they got in trouble.
Viacom,
Viacom.
Viacom.
Yeah. So basically, when those stocks lost value, it brought a huge problem down on Archegos, caused Archegos to get liquidated really early. So this is preventing SHFs like Archegos that don't have a lot of cash on hand from using too much securities as their collateral instead of cash. So if you don't have that collateral in cash, you can't enter that short position.
Right, right. You
And
have to
that's,
have 10% cash in that 40%.
yeah. And that also kind of protects the market from a fire
Imploding.
sale. Yeah, basically. All right. SFT clearing service would mitigate NSCC's liquidity risk associated with satisfaction of final settlement obligations owing to non-defaulting SFT members on novated SFT in the event of an SFT member default by providing for satisfaction of such final settlement obligations to occur in accordance with the normal settlement cycle for the purchase or sale of securities as applicable. NSCC would accordingly be able to satisfy such final settlement obligations through market action if necessary, rather than through its own liquidity resources. So
Hmm.
basically, by allowing the lender to just buy shares from the market and charge the shorter, the NSCC is reducing the risk on the non-defaulting members.
Right.
Because just like
Understood.
the DTCC, the non-defaulting members that are part of the NSCC, they donate to the insurance policy. This is now called. It was the SLD window. Now it's called like the um, required fund deposit. And basically,
They're
by
giving it
allowing
another name.
right, and by allowing, they're saying that by allowing the lender of the shares, like I said earlier, to basically just buy back their shares from the market and then charge the shorter, they are protecting the non-defaulting members from a bad actor just continuously piling up a tab.
Right, right. DTCC's got good actors and bad actors. Bad actors keep shorting meme stocks like AMC and GME, keep piling in. And then if this 803 rule is not in place, everyone has to pay the bill if the
Right,
market implodes.
right. So
These are very these are very tailor-made rules. Did you
exactly,
notice that, Major Tom?
I did. Now, here's another thing that I thought was useful here. For example, to the extent that market action is required by NSCC to close out the positions of a defaulting SFT member and selling out or buying in, as applicable, the entire quantity of securities would move the market and create disorder. NSCC would adhere to predetermined market volume limits as set forth in NSCC's internal procedures and execute its hedging strategy in order to meet its default management objectives. In such a situation, non-defaulting SFT members would not be able to effect a recall or an associated buy-in, since such market activity would exacerbate the disorderly conditions that NSCC's delay is designed to prevent, nor would non-defaulting SFT members otherwise be able to accelerate the delayed final settlement obligations. So basically, the NSCC will cover defaulting member positions slowly with volume caps to ensure the MOAS doesn't get violent and it's a managed squeeze. That's what that means.
Right. The term MOAS is not in the document. The term
No.
MOAS is a description by Major Tom. Okay.
Yes.
Right. Okay. Now, what that tells me is that the regulators wants a controlled process.
Yes, they're volume capping. So the NSCC will absorb these positions and close them, but they're volume capping their covering. If the NSCC absorbs the short positions, they're just going to keep the short positions for however long it takes to cover, and they're going to volume cap their own covering so it doesn't cause the stock price to go crazy bonkers.
Okay. Again, ELI5 scenario. Okay. I'm going to do a analogy. It's a little town in Wild Wild West. Okay. And there are good guy cowboys and bad guy cowboys. Okay.
Yes.
And these bad guys, and they fight each other with gunfights in the town, and without the sheriff. There used to be no sheriff, like NSCC Rule 803. There used to be no sheriff. So the good guys and the bad guys in this little town, Wild Wild West, they slug it out. Their gunfights kill each other and might kill the good citizens of the little town,
Right.
imploding the entire little town. The entire little town gets in trouble because of these two gangs fighting each other. Okay, in this case, the apes, the retails, and the SHF. Now, with this ADO rule in place, NSCC as the middleman, a sheriff sits in at the center of the little town and say, okay, you want to fight? Don't affect the entire town. Okay, only you
Yes.
two duel. Only you two go in a duel. You need a lot of water.
Yeah,
Hydrated.
this talking is getting me thirsty. So non-defaulting SFT members are kept in the same position as if the defaulting SFT member had not defaulted at all, and the pre-novation counterparties had instead agreed to roll the SFTs. To the extent NSCC is required to pay a price differential to a non-defaulting SFT member, NSCC would rely on the NSCC clearing fund, including the required SFT deposit, in order to cover the liquidity need associated with any such price differential obligation. So, what this is saying, non-defaulting members will not lose their lent shares when someone defaults. The lent shares stays with the NSCC, so they can clear it orderly, and the NSCC will pay the share price difference to the lender with the deposits. So all these insurance deposits that all of these non-defaulting members have been contributing to and the defaulting members have been contributing to, that money at the NSCC is going to be used to cover the price difference when I lend you my shares and the value goes up. I want my shares back. I want the price difference back immediately. Because
Right.
if I recall my shares and I can't get my shares because the NSCC netted your short position and they're just holding it there, they're not covering yet because they're
I know.
volume capped. The
Understood.
NSCC is going to use that insurance money to give me the price difference back. So I'm not worried like, oh, I'm going to
You're
miss
covered.
out. Yeah, I'm covered
You're safe.
right. I'm not penalized for lending you my shares.
Right. Here's the 5-year-old again. Here's the 5-year-old version because ApeAndy is 5-year-old. Okay. Now, NSCC is guaranteeing the good guys, you're safe and sound, not to worry.
Right.
I am going to take care of the good guys. Okay. I'm going to charge the bad guys. And you don't have to worry about facing the bad guy directly. I'm the middleman. Okay. I'm the guarantor. I guarantee you peace of mind and safety.
Yes. So
Okay.
the NSCC is
Proceed.
proposing a
Proceed.
sponsored membership program to allow members to play the role of pre-novation counterparty and credit intermediary for their institutional firm clients in clearing. It's talking about total return swaps.
Right. Okay. Is that part of the second video for next week?
I don't know if I'm going to do another video on total return swaps. Basically, all it is
You did
like,
one. You did one
yeah,
already. I saw that.
right. So basically, like,
You saw.
all that is a hedge fund goes to a bank and then the bank gives them leverage to buy shares or short
Right.
shares of common stock. That's all a
Right.
total return swap is. So
Okay.
including in particular certain agent lending banks, that the proposed SFT clearing service accommodate agent-style trading, where the agent lender enters into the transactions on behalf of its institutional firm clients with a third-party market participant rather than acting as its institutional firm client's pre-novation counterparty. Agent-style trading is the manner in which such agent lenders are typically approved to transact in securities lending transactions on behalf of their institutional firm clients. Okay, so this is just proving what I said earlier, that this is talking about total return swaps, because it's
Right.
literally like the exact definition of a total return swap.
Okay. So we got to the part of the document that Major Tom has covered before, total return swaps.
Yeah.
Major Tom, is the video getting too lengthy for our viewers? Is it clocking at 20 minutes now?
Yeah, it's like 25 minutes already.
Okay, let's not get beyond half an hour.
Yeah, so as proposed, the NSCC would also provide a mechanism by which agent clearing member may, upon default of a customer and consent of NSCC, transfer agent clearing member's transactions to the customer established in one or more of the agent clearing member customer omnibus accounts from such agent clearing members. Holy cow, I'm not even going to finish that. If a hedge fund defaults their dumb position, the banks can, with the bank's consent, be transferred to the bank instead of the hold on. Trying to read this note, but I can't even open it. So basically, if a hedge fund defaults and they're using the
Right.
bank for leverage, they can transfer the short position to the bank instead of the NSCC if they want to.
But please wait. Does the bank want to?
No, they don't.
Key point. Key point. Okay. Hey, Major Tom. Now, our viewers, they want our information digested and summarized in a nutshell. So
Okay.
that's why we don't want to.
All right. I'll stop reading the exact thing, and I'll just read my notes because
Yeah.
this is getting too
Yeah.
long. So
Okay.
a small hedge
Go
fund
ahead.
can break the rules for up to 30 calendar days if the NSCC says it's cool, but they got to cover after 30 days, and their sponsor must report their screw up. So basically, you have NSCC being the middleman, but the NSCC is only the middleman for big clients. Big clients. Small hedge funds, they can't get into the club. So small hedge funds get into the club through sponsorships. So let's say a big hedge fund or a big client can sponsor a little hedge fund. So let's say Andy has 300 billion assets under management, and I only have 2 billion assets under management, and I'm trying to get into the cool kids club. So Andy's going to sponsor me, and I'm going to short at the NSCC, and I'm going to borrow, at the NSCC, and Andy's going to be my sponsor. He's going to be like co-signing the lease on my house, and if I like default, my position goes to Andy.
I
Yeah.
get in trouble too.
Yes. So basically, this is saying if anyone breaks the rules, they have to report the rule that was broken to the NSCC, and they're basically have 30 calendar days to fix it. All right.
Okay. Right. So lots of new rules coming out. So the SHF, they are cornered. Their trickery are limited, right, Major Tom?
Yes. And if a sponsor member screws up, they have 1 day to report it to their sponsorer. So if I'm a little hedge fund and you're sponsoring me, I have to report to you that I messed up a rule within 1 business day. And then you have to report to the NSCC within 1 business day. And then I have 30 business days to fix whatever I screwed up.
Right. So because I'm sponsoring you, we're in this together.
Yes.
Okay.
You can't leave the NSCC with an outstanding tab.
Okay.
The NSCC must review all terminations for 10 business days.
Okay.
Hedge funds must pay taxes, no money laundering through cryptocurrencies.
Right. Okay.
You shouldn't need to help sponsored members because whoever sponsors them has a significantly higher dollar amount than the little hedge fund.
Right.
So the NSCC is pretty much taking away all of the risk from smaller hedge funds by just not even allowing them to be a part of the NSCC.
Right. She needs to be fed. This is Momo. This is Momo. Her name is Mo.
God, that's a cool
And
cat.
right, Momo. And do you know? This is Momo's. You know what they call this? Momo's ASS. That's MOASS. Okay. Okay.
All right.
Hey, we'll do another video next week. So
Yeah. So we'll cut it here. I think it's already at like 30 minutes. It's a long video. This is a super long recording, but you're starting to get like the summary of what's going
I
on here.
know. I
The
know.
NSCC is the middleman, and little hedge funds, they can't get in. They need a sponsorship. Big hedge funds, if they decide to, go short, they have to do it through the NSCC. And if they default, the NSCC is going to basically make sure that that gets covered.
Right. And the bigger picture, the entire market doesn't have to worry about imploding.
Yes, and the NSCC, when they do cover the short position, is going to do it slowly. It's going to be managed volume
Right.
caps.
Okay. That is my daughter, honey. Okay, signing off. We'll do another video next week.
All right.
Love you,
See
Major
ya,
Tom.
dude. Love you too, man. See ya.